Hi, everyone. Welcome to another episode of Stock Talk. This is episode 31. My name is Aman. I'm an investment coach at Sage Investors. And today I want to talk a little bit about some of my own personal investment decisions that I've made in the last little while. One thing that's as much as I spend much of my time teaching people and mentoring people and coaching people how to make better investment decisions, as much as I spend time teaching people how to understand a balance sheet or an income statement or doing financial analysis, it's one thing to do that, but it's another thing to practice what you teach, to model the behaviors of what you're teaching people. And so I take it really, part of my brand and part of my one of the core tenets really of my practice is to be very transparent and show people how I personally apply the various lessons and learnings and modules that I impart with people that I work with in terms of making investment decisions. So every month I post a blog listing out all the various different buy and sell actions that I've taken, if any. Sometimes I just don't do very much on various stocks that I've bought and sold, and sort of just share with you kind of like my thought process and how I formulated those decisions. So I posted another post on my blog on my website, sageinvestors.ca, and you can check it out. But today I'm just going to give you some highlights really of what I've done, just share with you what I've done. So a couple things I did is I added to some existing positions. Basically what's happened in the last couple of months, the Canadian dollar has basically ramped back up. It was like around 68 cents and now it's close to 78 cents. So I thought taking advantage of that appreciation, that bump up in the currency would be a good opportunity to add to some of my current positions in some US stocks that I own. So I bought a couple of positions. I added a little bit in terms of buying a little bit more of Nordstrom and Tiffany, which were on the luxury retail side. During the month, Nordstrom specifically they reported a pretty bad quarter and the stock got really taken out. It was like near $50 and then all of a sudden it went down to near $39. And I bought in at $45 and so I was down. So I thought I'd use the drop to basically add to my position in it and take advantage of the stronger Canadian dollar to get more bang for the buck. And even though the numbers didn't really look good, again, I'm not investing for a quarter-to-quarter basis. I take a very long-term approach. And to me, Nordstrom's approach in terms of how they execute a lot of their strategies is good. I think it's great compared to a company like Target that went into Canada just like gangbusters and thought everybody would just rush to their stores and buy anything. And the next thing you know, they shut down 200 stores. Nordstrom's, even though they're expanding into Canada, have taken a much more methodical, much more careful approach. They're willing to take time to understand the customers and learn and expand slowly. And I think that's a really unique process and a unique competency to have, especially in the management side of it in terms of how they're executing their strategy. So I like that. And the fact of the matter is the company's still generating tangible profit and they're printing money. So, even though luxury retail is kind of bummed and out of favor right now, that's the time you want to be buying stocks, when they're out of favor. And so this is a long-term, durable brand. And so I bought in at around $39, just averaged down my position. It's now at $42 a share. So to Nordstrom. Tiffany, same story. They didn't, their numbers are looking fine, but again, it's just this whole malaise right now in luxury retail of various factors. China, consumption going down in China in terms of luxury, less appetite for luxury brands. And so right now it's in a down cycle, but like history has shown, these type of companies are very cyclical, and the times you want to be buying these type of companies is when times are rough, times are down. But the fact of the matter is, even though sales are down, they're still printing money, they're still making tangible profit. And Tiffany is a best of breed brand. It's an iconic brand out there. They're not going out of business anytime soon. So, and their balance sheets are pretty strong, pretty rock solid. So I bought I bought some more shares in Tiffany too to average down my position. And finally, overall, even though I'm buying stocks, my general attitude towards stocks right now is I think the market's crazy overvalued. I think this whole near zero interest rate policy that the Federal Reserve and pretty much other central banks running around the world is insane. It's basically artificially propping up stock prices. There's no real reflection of stock prices with the fundamentals of going on in the economy going on right now. And I just think stock prices are just due for a severe pullback. And the fact of the matter is, last week with the Federal Reserve saying they don't really plan on increasing their interest rates anytime soon, shows that they continue to have chicken. They're just playing chicken and can't do anything. And so the incentive for stock prices to be more inflated are there. So as much as I believe stock prices are overvalued, it just wouldn't surprise me to see stock prices keep going up. So with that, I continue. What I keep doing is I keep adding every couple of months. I keep adding to my short position on the S&P 500, and I did that again earlier last week. So that story continues. So in a way, I'm kind of like, I guess, hedging in that sense, my exposure there. So that was in terms of what I've done. And now also in last month, I added a new position into my portfolio, and that is I bought some stock in Disney. Last month the stock was it was in about 110 bucks, and then all of a sudden it just started dropping. It went dropping down to like almost $97, $98, and numbers are fine, and I'll get into it a little bit, but that drop really forced me, kind of was a bit of a flag to me, like an alarm saying, you know what, you got to take a look at this because there might be an opportunity. Because Disney is one of the few companies I have on my list, my short list of companies that I'd love to buy, but I've always thought were expensive. And then just the rapid drop of the stock in the last month forced me to say, you know what, I got to dive in again and see if the fundamentals of the business are solid. If they are, then maybe worth picking up, maybe worth opening up a position. So I decided to. One of the things I do when I make investment decisions is I try to answer the 8 questions that every investor should be asking about a stock they're thinking of buying and selling. And so I basically apply my 8 questions model, and hopefully I should be able to come out of it with a bit of an answer. So I'll just walk you through how I went through my thought process. Question 1, what do they sell? Well, Disney, they pretty much sell entertainment. They sell content. So in variety, shapes, of forms. They have, the traditional Mickey Mouse, Donald Duck, Disney World, amusement park, Disney cruise motif. And then there's the cable side of the business with ESPN and ABC. And then the whole movie side of it with Pixar. And now they added Marvel Incorporated, all the superhero characters, and then of course there's the Lucasfilms, the whole Star Wars franchise. And essentially the business model of Disney is about acquiring and developing franchises, franchise characters, iconic characters, and then marketing the hell out of them through cross channels, through distribution channels, just going hardcore. When something clicks, like Frozen, they go hardcore on marketing that thing. And it's been in the DNA of that company since Walt Disney founded the company. And it's interesting, if you go on my blog, when I write about Disney, I found this really cool chart or graph, or I don't know what it is. It's just like a OneNote kind of thing that Walt Disney did, and he pretty much sketched out the entire company's vision and strategy on this one page. And it's got all these lines going all over the place and zigzagging, and channels and marketing channels and movies and do this, do that. It's fascinating. He developed this like 80 years ago, and it's still part of the DNA of the business. And they stay very, very, very true to that. And so that's what they do. That's what they sell. And they do it better than anybody else that I know out there. So that's what they are. That's what they do. Question 2. Competition. Well, they're in the content business, so they're competing with other people that generate content. So you're looking at your Comcast, your Time Warners, your CBSs. Those are the people that are, sending branded content. Who's buying content from Disney? Well, traditionally it used to be just kids, because it used to be about Mickey Mouse and Donald Duck, but now they have the whole Star Wars franchise. So now you've got a cross-section of Star Wars, crazies. I'm one of them. You got a whole Frozen franchise, all the superheroes and everything. So their cross-section, their reach now is not just the kids. It's really all segments of society. And the question is, that leads into, do people buy their content? If they buy it, will they buy their content over and over again? Well, the answer is yes, if they keep putting out meaningful content. So with ESPN, as long as they have live sports and live professional sports, people are going to tune into that over and over again. Star Wars, if they keep cranking out Star Wars, episodes, then people are going to come back and line up and buy their DVDs, stream it, buy Chewbacca masks, you name it. So chances are, yeah, people do want their content. They do want their products. Question 5, do they make money? Fundamental question. It took me 5 questions to get to this point, but does this company make money? If you look at their company's return on capital, it's averaging between 10 to 12% over the last 3 or 4 years. Cost of capital is about 9%. So when you factor that in, the company is actually making tangible economic profit. They're creating tangible wealth for their shareholders. Most of their wealth is created from the cable side, mostly through ESPN, because they charge really fat fees, monthly fees, and they're consistent, stable, and durable. Now, part of the reason why the stock has been maybe tanking a little bit is because there's been some rumblings that their subscription base is falling, and that whole cutting the cord concept might be coming into play, especially with ESPN. I'll get into that in a little bit later. That's one of my later questions when we talk about risk. You look at the company like their Star Wars franchise. They paid $4 billion for Lucasfilms, and recent reports that I've read said they're going to make their money back in like 2 years after they release the next 3 episodes. They're probably going to make their money back. So everything they're going to make after in 2 years is going to be gravy. That's insane. That's unbelievable. That's just a mountain of cash they're just throwing out right there. So, and then then we talk about all the other franchises. Frozen, Finding Dory. I actually went to see it with my kids on the weekend, and theater was packed. And they said it set a record for animation, for an animation film over opening weekend. So they're clearly creating buzz and creating content. Question 6, which is about the quality of their balance sheet. Is it stable, rock solid, or has it got issues? The one thing I thought I would expect when I started looking at their balance sheet was I thought I'd see a ton of goodwill and a ton of intangible assets, because they've been on basically a buying spree for the last 10, 15 years, buying up franchises and content like the Lucasfilm Star Wars content. The reality is only about 25% of their assets are in intangible assets, which I thought was really surprising and actually kind of cool, actually kind of impressive. Usually I don't like to look at companies that have goodwill over 20% of assets, but in this case they've just got this ability of identifying and really solid content. And if you're buying back companies and being able to justify them within 2 years, then I think you probably know you got some good DNA and good competency in the management side over there. Question 7, risks. Well, there are some risks. If you're in the content business, it's just that challenge of generating fresh content that people want to buy and people want to see and consume. So that's occupational hazard with these type of companies. The fact of the matter is they see it. They traditionally had always been the house of mouse and really revolved their strategy around nurturing and building that side. But over the last 15 years, they've really branched out and gone away from just that Mickey Mouse concept to now, Star Wars, to Marvel, to all the, I forget what it's Marvel, I think it's Captain America and stuff like that. But they've branched out, and that's helped, and that's really helped their brand, and helped their value proposition quite a bit. The cutting the cord situation I talked about a little bit with ESPN. I think part of the risks out there is that people will just say, you know what, I'm done. I don't want to pay outrageous fees for ESPN content. It's really great. It's really cool. I can see Wimbledon. I can see all the Grand Slam tournaments. I can see the Super Bowl. I can see all these things, but I don't want to pay for it that much. So people are doing that. I'm going to find other alternatives of getting that content. And so people are worried about it. I think that's feeding a little bit into some of the malaise in terms of the stock price. But the reality is, they own some of the most prime content out there. All the major sports, they are all in on it. And live content is gold in the entertainment business. So I think it's a lot to do with about nothing, really, at this point. The other risk is also they're kind of shackled a bit. About 3 or 4 years ago, and I was reading about this, they did a deal with Netflix. So they basically gave Netflix full access to the Disney library. And Netflix is paying them about $300 million, $400 million a year to access this content. And they locked the deal up until 2020. And so it's fascinating because a lot of people are saying Disney made a huge mistake doing this deal, because they could have just gone out and done a lot of this distribution themselves and probably would make a lot more doing that. So a lot of people think the stock or the company's earning potential is really kind of hamstrung or kind of constrained a bit because they're tied into this Netflix deal. And if you actually look about it, one of the big reasons why Netflix is what it is right now is really because of this deal, because of their ability to get all this Disney content. So the bad news is they're kind of locked into this deal until 2020. The good news is it's not like a 50-year kind of deal. after 2020 they're free and clear. They could do whatever the hell they want. Disney could do whatever the heck they want. And so a lot of people are thinking, and this is the trend really, is that a lot of these content farms, like a Disney, like an HBO, are just saying, you know what, we're going to forget about the middle guy, and we're going to create our portal ourselves, and we'll charge people directly to use that. And so a lot of people think Disney's just going to be in the process of creating this mother of all kind of interfaces, portals where you can access, if you want to see Star Wars 100 times, you can go through there, pay a subscription. You want to see Frozen 50 times and anything around it, any content associated with it, you pay for that. Or if you want to see everything, you pay for everything. And I think that's kind of looks like a trend, and technology is really the big factor that's enabling this. So it wouldn't be surprised to see Disney 4 or 5 years out, kind of out with their own little one-off platform, the one-off ecosystem kind of thing. And it could potentially be very lucrative. But right now, the stock probably isn't showing that or factoring that in. But it's out there, and it's it's a risk. It may work, it may not work. We don't know. So that's probably a side of it. So that's 7 questions. So the 8th question. Okay, so after answering all this, how do I feel about the stock? Well, I think, as I said, it's a best-of-breed content provider. It owns some of the most prestigious and valuable and iconic brands out there. It throws cash like ridiculously out there. They have a pretty clean balance sheet, and they generate content that is constantly being reconsumed and consumed and consumed. And when you put all those factors in, the fact that the stock is down from $110 to $97, I thought the stock was it's out of favor. I think the analysts are out of favor on it, and I think there's a lot of negative sentiment on it. I thought, you know what, this is a really good quality company that's on sale, that's being discounted. So I said, you know what, I'm going to open up a position. So I opened up a small position, and the stock. I think the stock very much could fall further, and if it does, then I'll buy more. Because I'm looking at from a long-term perspective. I'm not just looking at it to trade and flip stocks. So that's kind of like how I approach these things, and that's how I work with people, is trying to get people to ask these 8 questions to themselves and be able to answer them, and then come out of it with basically a pretty good sense of whether they want to make an investment decision or they want to sell or buy a stock. So that was my thought process, my mind map, I guess, of Disney. So I thought I'd share that with you. That's pretty much all I got for you today. If you want to go check out my blog posts on Disney and everything, I go into a lot more detail on it. I go to my website at www.sageinvestors.ca. If you want to hit me up with a question or anything, you can go to my website, or you can go hit me through Twitter. My handle is @sageinvestors, and I tweet about all, as I said, my personal investment decisions, my observations on the market, coaching kind of things, investing decisions, all things stocks. I tweet it out in real time, so feel free to follow me and check me out. That's pretty much it. That's another edition of Stock Talk. My name is Aman of Sage Investors, and we'll catch you again another time.